Hello class, this is the chapter 5 handout 1 answer video. So let me get my sheets pulled up here. Let me get my screen share. This is what I'm going to go over. Hopefully you've tried to work this out on your own and just use this as a supplement. Check and make sure you're understanding the concepts. All right, so first we got Gordon Grocers purchases bread from Buddy's Bread Company at $2.35 per loaf. Recently engaged in a contract to purchase 26,000 loaves with credit terms of 2, 10, and 30. They expect to pay within the discount period. Okay, so it says prepare the journal entries for payment collected within the discount and after the discount. And the first thing is we need to calculate how much are we actually going to initially record this as. Using the net method, we're going to record it as what we actually expect them to pay. So we expect 26,000 loaves times $2.35. So 122,200. But we only expect to receive 98% of that because of this 2% discount up here. So 119,756 is what we actually expect to collect. So when we're making our journal entries, on the date of sale, we would make this entry. We would debit our accounts receivable because they're increasing our asset, and we would credit our sales revenue for the amount that we just calculated, the 119,756. If they paid on time, we would debit our cash and credit our accounts receivable. Because we'd actually be receiving the cash they no longer owed us, so we can take that away, and it would be in the exact same amount. However, if it was late, then we are going to receive the full amount of the selling price. So if we look here, the full amount was this 122,200. Okay, so that is how much cash we would receive if they paid late. We still take our receivable off, but we have to take it off at 119,756 because that's all we thought we were going to get from them. And then the difference, in order to make our accounts balance, we're going to have to record the rest of the sales revenue. 2,444. Okay. And that's how you would make your 3 journal entries on the date of the sale, if they paid on time, and if they paid late. Okay, question number 2, Able Enterprises has a financial planning service. Each customer pays $25,000 for receiving. So that makes it as $750,000 in credit sales, and estimates 4.5% of its credit sales will be uncollectible and during the year wrote off. Okay, so we're doing an allowance method here. We are estimating by the percentage of sales method. So first it says prepare the journal entry to record the defaulted balance. Well, the defaulted is what they know is not going to pay, so it's 3,300. Using the agent method means we're using an allowance method. So when we're going to journal the default, when we actually make the write-off and it's defaulted, we are going to take it out of the allowance for doubtful accounts, that contra account to accounts receivable that we always, whenever we record bad debt expense, we put it into there with a debit or with a credit. And then when it actually happens, we take it out of there with a debit and we lower our receivables. And I forgot the amount already. I believe it was 3,300. It is. Go back to our journal sheet here. So 33. That does that. $3,300 there. Okay. Next is going to ask us to record the bad debt expense for the period. Okay, so how do we calculate the bad debt expense when we're using this method? We take the credit sales, 750,000. And we multiply that by 0.45 or 4.5%. It's 33,750. So that number is what we're going to record as our bad debt expense. There is no other calculation. Remember, when we do the aging method, we have to do one extra step. 33,750. So to record this as bad debt expense, in our ADA, the allowance for doubtful accounts is what we're going to credit in this instance. And it was at the amount that we just calculated. 33,750. Okay. That's how you would do question number 2. Question number 3, on January 1st, Hunger Man has the following balances for receivables and allowances. Okay, so this is the beginning of the year. We're given some balances here. Notice that the allowance for doubtful account is starting with a credit balance, which that is important. Okay, we had 18,500 of credit sales, collected 17,944 and wrote off. Some accounts receivable is uncollectible. All right. So it says calculate Hunger Man's pre-adjustment balance and accounts receivable. And then the second part is the allowance for doubtful accounts. So let's make two T accounts here. We have an accounts receivable and an allowance for doubtful accounts. We have a beginning balance that is given for both of them. So we have 1.28 million in our accounts receivable. Normal debit balance, so we put it on the debit side. The allowance for doubtful accounts is 44,000, and it tells us it is a credit balance. So we have 18,500 of credit sales, collected 17,945 of those sales. 18,500. So if we were going to journal this, when we make the sale, we will take up our accounts receivable, we will do sales revenue. For $18,500,000. Okay, so that would be our journal entry for the sale. That is why our accounts receivable, when we pull it over here into our T accounts, we will make that go up by 18,500. On our collections, are actually going to be our credit to our accounts receivable for 17,945. Okay, that's because when we collect it, we're going to debit our cash. We credit our accounts receivable. 17. Okay, so that is our collections journal entry. Okay, so we have that posted onto our ledger also into our T account. At the end of the year, we almost sent it there and wrote off $60,000 of accounts receivable as uncollected. So again, since we're using the aging method, that is an allowance method, when stuff becomes uncollectible or default, what was used in our last question, so it's default when we know we are not going to collect it, then we're always going to debit our ADA to take it out of there, to make it lower. We can credit our accounts receivable at this point because we are not going to collect it at all. We can take it off the books as being something we expect to collect of $60,000. Now we move those two journal entries into our T accounts. So we had a 60,000 credit entry and a 60,000 debit entry for that one. Okay, so that's all we have to do first to calculate the pre-adjustment balance in our accounts. Okay, since my accounts receivable normally has a debit balance, that's a 5 there. I'll write it up better for you in a minute. I added up my left side and subtracted what was on the right. It's a normal debit balance. That's what you can do to find the account. So the accounts receivable was $1,775,000 by doing this adjustment. What was the pre-adjustment balance and allowance for doubtful accounts? So we have 44,000. I can minus the 60,000 and find out that I have a 16,000 balance, but it is on the debit side. On this one, you need to note whether it is a debit or a credit. Okay, so while we normally increase it with a credit, it might actually have a debit balance. That means they did not estimate enough beforehand. Okay, so if it comes in with a debit balance, that's not just in the period before this one, our bad debt expense was too low. We did not estimate enough. So we're going to have to estimate a little more this time. If we had a credit balance here, like it was here up at the beginning of 44,000, it means they didn't estimate enough. They expensed more than actually happened. All right. So then now it says prepare the adjusting entry for the year. We did not have to go through an aging chart to figure out what it was going to be. Instead, it tells us we estimate 52,000 will be uncollectible. Remember that number becomes our ending balance. Trouble drawing 5s today for some reason. Let's just erase that. Let's try again. We need 52,000 to be the ending in our ADA account. Okay. So in order to make that true, we need to make an adjusting journal entry for the amount right here. So if it's on the debit side, we need to make it larger than the 52,000. We need to add them together. And we need to make an entry. Credits allowed for doubtful accounts by $68,000. So we go to our journal entry then. We put our bad debt expense. Along with our ADA for $68,000. And that's that extra step when we do the aging method as compared to when we do the percentage of sales method. Okay, it's just calculating how we get a different bad debt expense out of there. Two different ways. Okay, hopefully that helps you. That's the heart of kind of chapter 5. And some simple examples there. If you have any questions, you can do your homework, don't forget to reach out to me. And there's a handout 2 also, which covers some credit card sales issues and notes receivable and how to collect the interest on those. So be sure to watch that also.